Here on set with us to discuss all of this and more is Don Peebles, CEO and Chairman of the Peebles Corporation. Always good to have you in the house, Don. Good to see you.
Good to be here.
If I'm reading you right, you think that some of the most opportune markets are among the most challenged markets right now. New York, San Francisco, among others, while some of the hotter markets, Dallas, Fort Worth, Miami, and others, maybe you're staying away from. Am I reading you right?
Sort of. So you're right in terms of opportunistic. We're an opportunistic company. So we look to develop when markets are supply constrained, and then we like to buy when we think there's tremendous value. And what we're seeing here in the commercial office space is essentially once in a generation. We haven't seen
opportunities to buy.
Opportunities to buy. Nothing like this has happened since the early 1990s, when we had the banking crises that resulted in almost 900 banks being closed in less than 3 years.
And you were able to pick up properties in, say, Phoenix, Dallas. That's where a lot of the banking problems.
And Washington, D.C. as well. We were buying buildings at 20 cents on the dollar in Washington, D.C. In fact, that was the very foundation that propelled our company to be able to go and make acquisitions and develop in other parts of the country.
Let me zoom out before we zoom back in, if I might ask one more question, and that is this. At the top of our broadcast today, we had a guest, a former acting U.S. Labor Secretary, who said that this morning's jobs numbers put a stake in the heart of the recession argument. The economy is healthy, it is growing, incomes are up, inflation remains at, maybe it's not at bay yet, but it's been somewhat tamed. And he sees it that way. You seem not to see it that way.
Your second guest, or who Rick interviewed in Chicago, he saw it better. I mean, I thought initially I was listening to one of the Biden's campaign managers.
Well, he did. That gentleman did serve in the Obama administration.
I know. So, look,
the apple doesn't fall far, as they say.
Look, many of the jobs are part-time. The jobs he's talking about, the union jobs, are skilled jobs. And the construction industry already has challenges of workforce because there's so much demand. There's been a demand for a while, and it's been driven by commercial real estate activities, not infrastructure investment, and it's been in areas that are business friendly.
Though he maintained that the infrastructure investments would fuel growth in good, quote, middle class jobs.
If the government could actually deploy the capital quickly enough. And unfortunately, it goes from the feds to the states to the cities. And that takes a while, unfortunately. It's a very inefficient process. And so the other thing is that these statistics don't register the cost of capital. The fact that it costs 2.5 to 3 times for an American to buy a home today. The fact that rents in Miami, for example, are up over 33% since 2020. Those kinds of things, the cost of housing and the cost of capital, the fact that Americans have record credit card debt right now, those kinds of things, that's the real killer in terms of inflation for the average American, or to buy a car. And so I think that we are in an environment where there's a lot of risk, there's some instability, and I think commercial real estate, which has been a big employer, big job generator in major cities around the country, they're not going to be able to do it now. I mean, think about New York, San Francisco, and other places where real estate development created a lot of economic opportunity.
Right, but you're sort of net optimistic, right? And you're finding opportunities in some of these beaten down markets. How strong a stomach do you need to have, or how long of a timeline do you need to have?
Well, I mean, look, I don't think it's that scientific, actually. I mean, I think, look, Washington, D.C., real estate values are down 60 to 70% for commercial office buildings. Los Angeles, down 70% or more. San Francisco was down 60, 70%. Those are global cities that will come back at some point in time. And so you have to have the appetite to buy, understand how to stabilize the assets based on the current income potential, and then wait.
You don't think there's something structural that has changed in a place like San Francisco? Last time you were on, we talked about this, and that's where I live most of the time. And the remote or the hybrid working environment has persisted. That has changed. So when you say it's going to come back, is it going to come back to pre-pandemic levels, or what are you expecting?
Very differently. One, I think inventory and supply. If we talk about commercial office space, for example, inventory and supply will decline. Many buildings are going to get converted or repositioned or demolished, and so the market will adjust to a form of hybrid workforce. I do not think, if you look at what's happening in New York, for example, hybrid workforce is there, but it's not remote working 4 days a week. It's down to 2 or 1.